today. It is the flagship company of Raipur-based Hira Group of Industries. It is an integrated steel company with a presence across the steel value chain. Their vision is to become one of the most competitive integrated steel plants with the entire value chain, right from mining to finished steel with diversified products. So let's begin with how the company was established. So it is a prominent, fully integrated steel conglomerate, and they have achieved significant growth since their inception. And they commenced their journey in 1970 as a trading business, and since then they have expanded their capabilities. In 1999, they established a 300 tons per day direct reduced iron kiln, which served as a starting point for them for exploration of their new businesses, basically, and the current value chain that they're spread across. Today, they stand as the largest iron ore pellet manufacturer in central India, boasting a capacity of more than 2 million tons. So they have successfully secured iron ore mining rights for captive consumption, ensuring a steady supply of their main raw material, that is iron ore. And as part of their forward integration strategy, they have created a successful value chain as well, which we'll get into in the further slides. So, yeah, they also have captive power plants, etc. So they're both forward integrated and backward integrated. It was founded by Mr. B.L. Agarwal in 1999 and got its current name, Godavari Power and Ispat, in 2001. So they transitioned from in 1998 into power generation as well under the name Ispat Godavari Limited, and this was like a turning point in their business. So yeah, so if we talk about their journey from in 1999 they came into existence, and 2001 to 2004 we can see they were adding capacities, and their goal was to become a fully integrated steel manufacturer by establishing a sponge iron plant, and they wanted to expand into steel billets, ferroalloys, wire rods, and rolled products as well through their subsidiaries. So also during this time they set up that captive power plant as well, utilizing waste gas from the sponge iron plant for their power generation. So this allowed them to exercise control over their production process and then ensure consistent quality as well. Then then they also in 2008 they acquired a stake in Ardent Steel. Ardent Steel supplied iron ore pellets to near that it is in Chhattisgarh, and nearby they used to supply sponge iron units as well as shipped them to the Chhattisgarh market. So but as of 2022, they have identified this Ardent Steel and one more company, that is Godavari Green, as non-core assets, and they have sold off a 42% stake in Ardent Steel to a strategic buyer in Odisha. So in 2011, they merged Hira Industries and RR Ispat to simplify their whole group as such. And in 2016 to 17, again, they were expanding their mining capacities. They have two mining ores. They were expanding capacities across one of them. And they also had to do a debt restructuring during this time, because even though their production was increasing and they are producing higher volumes, the company was unable to break even or let alone even make profits, because during this period globally the demand was much lower, and also the steel prices had fallen. So to avoid like default in payment, because they had taken a lot of debt by then for their capacity capex, etc. And so to avoid default in payment, they had to get their debt structured. Also on account of cash flow mismatch, and then their operating margins also fell during these 2 years, 2016, FY16, FY17, and yeah, they defaulted in repayment of debt basically. So the promoters had to bring 31 crores by way of equity in the company. In 2020, again, rolling mill, they increased capacity of their rolled products. And then in 2021, they started moving towards their net debt-free goal. And they were moderating their carbon footprint also by then. And they commissioned a 70 million watt solar plant in Rajnandgaon for rupees 260 crores, and power generated from this plant was to be captively consumed, replacing the grid power which was originally being imported and leading to substantial power cost savings for them. Yeah, so this plant is ready, but the grid synchronization is yet pending. In 2022, they simplified their group structure further. Like I said, they exited non-core businesses like Ardent Steel and disposed their stake in Godavari Green Energy Limited as well. So let's talk about their business segments, their products. So firstly, we have iron ore mining. This is not a product, but this is their main source, as in they have two captive mines. One is called the Ari Dongri mine and Boria Tibu. Other one is Boria Tibu mine. Both are situated in Chhattisgarh. So GPI Godavari, they source 100% of their iron ore needs captively from these mines for the production of steel. That is, yeah. So the main point is they get 100% of their iron ore from their own mines. So captive mining, this leads to huge raw material cost savings, which we'll see further. Uh, so another one of their products is iron ore pellets. So pelletization is a process which converts they use to convert iron ore into fine pellets. So the iron ore that they get from their mines, they convert it into fine pellets, which can be further used for production of sponge iron or pig iron. So the process basically involves agglomerating disintegrated iron ore fines into pellets suitable for downstream iron making applications. So yeah, so the final iron ore pellet processes, they are basically used in the production of steel and alloys, and they are basically high grade pellets. So they are used for making billets as well. The company itself makes billets. So one, you can say one product becomes the uh, end product. One product becomes the raw material for another product. So, yeah, so the company's steel quality is at par with large primary steel producers. And then they also make sponge iron. So they have become a very prominent manufacturer of high quality pellets, firstly, and iron ore based sponge iron as well with low phosphorus content, resulting in the production of ISI certified products. So their advanced sponge iron manufacturing process uses four kilns, including a 350 ton and three 500-ton capacity, and the company has achieved a leading position in DRI. DRI is a direct reduced iron production in India. So the DRI is also known as a coal-based sponge iron. It is a metallic product derived from the direct reduction of iron ore in a solid state, resulting in a sponge-like appearance due to the presence of pores from the removal of oxygen. So there's a picture here as well. Uh, yeah, so the process is basically called solid reduction process, where a non-metallurgical coal is used as a reduction agent. It is one of the reduction agents, but the company specifically uses coal as a reduction agent. So what happens is you get high quality, non-contaminated Fe iron suitable for steel making. So this can be used as a raw material for manufacturing steel through electrical arc furnace and the induction furnace routes. And yeah, considering the fact that large quantity scrap required for manufacturing steel and supply of which is irregular mostly, sponge iron is rather a better substitute of offering a regularity in supplies and quality. So a major portion of the sponge iron that they produce is used in-house itself for the manufacture of steel billets, and excess is sold in the market. Then yeah, we come to steel billets. Steel billets is basically processed iron or steel with a square cross section as shown in the picture, and it is formed after hot rolling with high ductility. So billets are produced out of pellets-based sponge iron, resulting significantly positive impact on the re-rolling process due to its surface finish and chemical property, which holds good at testing parameters. So, sponge iron and scrap steel are processed to remove impurities and are converted into refined metal, basically. The refined metal then in their molten state is solidified into billets. So billets are meant for re-rolling of strips, wire, bar, hexagons, profiles, and etc. They're used for mechanical working, and they're also primarily used for manufacturing of wire rods, from which further steel wires are made, and then also TMT bars, angles, channels, then beams, etc. Then we come to their rolled product segments. So in rolled products, they have two products, that is wire rods or MS rods, that is mild steel rounds, or HB wires, that is hard bright wires. So these wire rods or MS rounds, they are an intermediate input for steel plants as well as for industries like construction and infrastructure. They're used in manufacture of wires, basically. Yeah, so GPIL makes mild steel wires through cold drawing process using the steel wire rod. HB wires are made from rolled steel through wire drawing. It is produced from conversion of steel wire rods by reducing the size from their original size, that is 5.5 mm, to between 2 mm to 4 mm. So they again serve as a raw material for construction and infrastructure. So these wires, they are rolled products. They find application in the infrastructure sector, mainly in construction, railways, power transmission, etc. Then we come to ferroalloys. So the high carbon silico manganese or ferromanganese is an alloy of manganese and iron with additions of silicon, carbon, and other elements. The raw materials such as manganese ore, coke, quartz, etc., are basically charged into a furnace where they are smelted at 1700 or 1800 degrees Celsius by electric power supplied through three carbon electrodes, and the alloy and slag produced in the furnace are tapped at regular intervals to get the final ferroalloys, basically. So the ferroalloys such as silico-manganese, ferromanganese, etc., they're used as additives in making steel along with sponge iron, scrap, etc. And the surplus production is sold in the open market again. And then we come to their power segment. So power, electricity is one of the more main inputs for them, and one of the major cost components as well in the steel manufacturing process. And most of the electricity that is generated by GPIL from their captive power plants is consumed captively itself. So the surplus power is sold to the state grid. So then, yeah, they generate power through waste heat gases from their sponge iron kiln, which qualifies for carbon credit under the Kyoto Protocol. And they are the first company globally to get the carbon credits for waste heat recovery power generation. And for all their steel products, their buyers are mixed between China, Korea, Japan, and the Middle East. And and domestic buyers include bigger mills like Tata, JSPL, etc. They don't talk much about their clientele, but this is some information that I could get. Then, yeah, this is their steel value chain basically. Now we've talked about all the products. So how it works basically is iron ore that they get from their two mines. Then they are used in the direct firstly, they're used to make iron ore pellets. I think I'll use the pointer just a second. Yeah, firstly, they are used to make the iron ore pellets, and secondly, they are used in the direct reduction process of iron to make sponge iron. Then the sponge iron pellets are further used to make the billets, and then the billets are used to make the rolled products, that is the MS rounds and HB wires. And then also they have their ferroalloys division that is made from silico-manganese or ferromanganese. So basically, one product becomes the raw material for another product. And coal, what happens here is they do have coal mines as well. They have captive coal consumption, but in sponge iron, what happens is they require imported coal. So that is one thing that they import. And power, as we said, power, they generate their own power and they meet their requirements by their captive power plants as well. Then Yeah, so this is the product wise split as of FY23. We can see majorly INO pellets uh, co- comprise major most of their revenues, and then we have MS rounds and then the other products. Usually, what used to happen was the sponge iron. Firstly, iron ore pellets have always remained their most volume product, and then secondly, there used to be sponge iron. But what happened in FY23 was they used all of their capacity, so they couldn't produce more of sponge iron. So that's why it is only at 7.9%. Whereas in 20 FY22, it was at some 23% of the total sales. EBITDA split, if we see, then 69%, 68% comes from steel and 32% comes from the power that they sell. And lastly, a location-wise breakup. This is as of FY22 though, but you can see the export sales are around 42, 41%, and the domestic sales are 59%. Yeah, so these are their plants and mines. Yeah, sorry. So most of their plants and mines are located in and around Chhattisgarh, except these two other locations that where they have a windmill in Karnataka, and the biomass is basically converting the uh, waste heat into power that is in Mahasamund. And then first, they have these two mines from where they get their captive iron ore. That is Ari Dongri iron ore, Ari Dongri mine and Boria Tibu mine. Both are situated in Chhattisgarh. And then they have a power plant in Chhattisgarh as well, two power plants, and then pelletization plant in Odisha. And then there's their biggest plant, that is Siltara integrated plant in Chhattisgarh. Here they do all sorts of, that is iron ore beneficiation, then iron ore pellets, sponge iron, steel billets, wire rod mills, HB wires. So basically, all the products that are there in their value chain. And then in the Ulla industrial area, they have again ferroalloys and then captive power as well as the wire rod mills. Yeah. So raw material. So the main raw material that is required for manufacture of steel is iron ore and coal, and raw material integration in the form of iron ore and ore mines and long-term linkages for power supply in the form of capital resources and power purchase agreement with its associate company that they have become a key advantage for them. They source 100% of their iron ore needs captively from their two mines for the production of steel. And this, what happens is, because of this cost of iron ore and coal that is sourced through the open market is usually much higher, and as compared to the raw material that they source from their own mines, and same with power as well. So only thing is their company's sponge iron plant runs only on imported coal, as the domestic coal quality is often inferior quality. So they import coal from South Africa. So these are the products, and we can go one by one to what raw material they require in each of the products. So sponge iron, they require iron ore and coal, out of which the coal is imported. Iron ore they source captively. The iron ore, like I said, sorry, the coal I said, like I said, it's imported from South Africa. Steel billets, again, sponge iron and coal. Coal that is here, the coal that they source from their captive coal mining is used, not the imported one. So again, they're using their own resources here. HB wires, wire rods, which are already a part of their value chain, are used to make hard bright wires. And then ferroalloys, manganese ore, which are sourced from their own silico-manganese plant, are used in the making of ferroalloys. And power, again, power, we've seen that they have power plants and windmills as well as solar plants, and they're increasing the capacity as well. So the power requirement is majorly met from the captive power generation itself. So what happens is, well, like I said, one end product becomes the raw material for the other, and they are both backward integrated and forward integrated, which leads to better margins for the company. So yeah, like I said, the captive mining thing, this is a snapshot from their investor presentation. Captive mining provides them a competitive edge because if you see, I'm assuming this is in rupees per metric ton. So the market price of iron ore, that is, it is at rupees 5,560. This is as of quarter four FY23. It is at rupees 5,560 per metric ton. But because they source their own iron ore, they and end up at a rate of rupees 3,100. Because of the backward integration, they have been at a rather stable price. Even when you see here at quarter one of FY23, when the price is at 7,800 rupees, they are still coming to a price of 2,900 rupees. So this is a key advantage for the company. So board of directors, I don't have much to say, but then I'll just talk about the promoters. So Mr. B.L. Agarwal is the one who started the company. He's an electronic engineer. He started the company by borrowing around rupees 33 lakhs, and it started as a 300 tons per day DRI kiln in 1999. So, because of this man's curiosity for innovations, they basically ended up installing the first 350 tons per day kiln with in-house technology, and after that, they have continued to increase and expand their DRI making facilities. And then eventually he led GPIL into an IPO in I think 2007, making it a publicly listed company on the BSE and NSE. Yeah, so that's all I'd like to say here. Rest all is readable and they all justify their role basically. So this is the group structure. So Godavari Power and Ispat, and then they have two subsidiaries, that is Hira Ferroalloys Limited and then Godavari Energy Limited. So Godavari Energy is only owned subsidiary. Hira Ferroalloys, they have 76% stake, and then they have one associate. It shows two here because this is picked up from their annual report of FY 2022. This one was to be this Jagdamba Power and Alloys was to be consolidated back then merged with Godavari Power, and this has happened already in FY23. So they have only one associate, that is Ardent Steel, and they have 37% stake in it. And then they have certain JVs, that is Raipur Infrastructure, Chhattisgarh Captive Coal Mining, and then Chhattisgarh Ispat Bhumi Limited. So these were respectively for development of coal mines and then setting up railway siding, respectively for their own captive use. So yeah, this is the simplified group structure. Let's talk about the shareholding pattern. So as you can see, it is a promoter-driven company. They hold more than 58%. They hold around 68%. And yeah, they have not pledged any shares. So the rest is held by DIs, majorly by the public. That is around 28%. And 3.46% held by FIIs and then 1% held by DIs. Yeah, and then let's talk about the promoter holdings. So the promoter family is the Agarwal family, and they hold around 57% of the stake in the company, and the rest are held by the group companies of Hira Power and Steel Limited. So they hold altogether around say 10%. Yeah. So majorly the Agarwal family holds shares in the company. Forensics analysis, the company did pretty good. They scored 78.3%. That is 18 out of the 23 checks they passed. And let's get into the ones in which they were not able to score. So is the auditor a large, well-known firm? So their auditor is JDS and Company. They are merged with Singhi and Company. Singhi and Company is relatively well known, not widely known again, but yeah, they are the auditors of the company. So they're not a widely known company, but they have audited for Tata Steel, then Sarda Energy, Rupa, and also other prominent companies. So it is not a cause for concern. And then there's does the company buy from or sell to promoter, KMP, director controlled entities? So the company has sold goods worth around 34 crores to Hira Ferroalloys, then Ardent Steel and Jagdamba Power and Alloys, Also, they have bought goods worth around 10 crores from Hira Ferroalloys and Hira Cement. However, the RPT to sales ratio is at 2.23%. So this is again not very concerning. However, the total contingent liability to their consolidated net worth as of FY22 comes to around 11.18%, that is greater than 10%. So they have liability contingent liabilities amounting to rupees 370 crores, whereas the net worth of the company as of FY22 stands at 3,312 crores. So again, their other expenses are greater than 15%. It's at 18.4%. But they mentioned that it increased mainly due to increase in consumption of stores and spares, power and fuel cost, and freight cost due to higher volumes for export. That is true because they were in FY22 they had exported the highest volume and yeah of iron ore pellets and wire rods. So, and one more thing was the dilution of equity. So that comes to around 115% in the last 10 years. And then in FY22 as well, they had done a stock split in the ratio of 1:2. And also they issued 6.8 crore more bonus shares to their investors in FY 2022. Next, we move on to the key metrics. So yeah, business value generation, we look at their revenue and PAT first. So if we see over the years from FY14 to 23, they have been able to consistently grow their revenue, except FY16 and 17. Like I said, there was a fall in prices in steel and there was lower demand globally. This basically resulted in a net loss for the company, and they also margins also fell. They were disrupted. Even though their order book was large during these years, they were not able to execute the orders because of lack of capital and also because they had a huge amount of debt that they were already defaulting on. Yeah. So after that, they have been able to grow consistently. And in FY22, they saw the most demand, and as well as higher prices also helped them. So this, I would say, is a combination of both volume-led growth and then price-led growth in FY22. In FY23, again, their sales increased, their revenues increased, but however, their PAT fell because one was the government of India imported steel import duty in Q2 and Q3 of FY23, because of which their margins fell, and also their sponge iron capacity was fully utilized at 99.99%, resulting in the majority of the sales being focused on pellets and other products. So, however, the export duty was relaxed in November 2022, and the prices have increased since then. So, yeah, they're on. Since then, they have again been able to increase their PAT quarter on quarter. Yeah. Also in FY23, they had an exceptional item loss on account of the derecognition of their stake in Jagdamba Power and Alloys, because upon acquisition of the power plant on a slump sale basis. This amounted to around 15 crores as well. Small amount, but yeah. And then their ROE, ROC as well. In FY23, it declined due to the same reasons, and in FY22, it was at the highest. Yeah, if we talk about the EBITDA and EBITDA percentage, they since FY14 and until FY21, they've been pretty consistent. They have always been about 20%. However, in FY22, it fell to around 18%, and then FY23 to around 10%. That again is due to the set two reasons. That was the import duty, and as well as their focus being on more pellet sales and the them reaching the full capacity of the sponge iron sales. But in the latest quarter, however, their EBITDA margin is back to 20%, and according to the management, they are guiding for 18 to 20% margins for FY24. One sec. Yeah. So yeah, with PAT again, their highest PAT was in FY22. That is because there was higher demand for iron ore pellets in international and domestic market, and then also higher demand of sponge iron and other finalized other finished products. And then realizations also increased for them during this year in the first half of the year as well, even for ferroalloys, and this led to also better margins quarter on quarter, and that resulted in a better PAT margins, I meant. Yeah. So this I've already discussed. So the PAT fell in PAT fell in FY23. So regarding capex, if we see since FY22, they've again been doing large capex, and what since the last 2 years, their projects include capacity expansion, then iron ore beneficiation, and then solar power plants as well, and other few debottlenecking projects. So mainly, they are focused on capacity expansion of their iron ore mining, and also their coal mining, and also mainly on increasing their power generation. And then they have announced a greenfield capex of rupees 2,000 crore, which is currently at its preliminary stage, and it is likely to be completed by the next 3 to 5 years. So what the management says is they expect rupees 500 crore annual capex for FY24, and out of this 2,000 crores, 1,000 crore capex, they have already mentioned how it is going to happen in their investor PPT. It is in the next slide. I'll show it. But yeah, this is to be incurred entirely by internal accruals, and the company is determined to stay debt free in the medium term. So their capex plan, this is in the latest investor presentation. So one is iron ore mining. So their second mine is the Tibu mine that only has a capacity of 0.7 million ton. But here they can expand. They are doing a greenfield expansion. So they want to increase the capacity by another 3.65 million ton. That brings their total capacity to 6 million ton. So this will cost them approx 200 crore rupees, and it will take them 18 months. And with pellets as well, they want to increase the capacity by 3 million tons, bringing their total to 5.7 million tons. And this will cost them another 800 crores, and this will take them 36 months. So the combined amount is 1,000 crore, and this 1,000 crore will be funded entirely by internal accruals. So yeah, the update on the project is that it is still in their preliminary stage. They are looking for approvals from the Ministry of Environment, Forest and Climate Change of India, etc. So their application is still in process. Now let's go on to the peer comparison quickly. So for peers, I've taken Shyam Metallics, Lloyds Metals, Sarda Energy, and Sandur Manganese. So like GPIL is both forward and backward integrated. They captively source their iron ore as well as their power. And the most identical peer would be Shyam Metallics because they have the same presence in the steel value chain. And while we talk about their captive consumption, they don't have captive mines, but they have leased uh, mines in Maharashtra, and they do have a captive power plant. Whereas Lloyd Metals, they own a mining lease again for over 350 hectares in Maharashtra that is valid until 2027. And Sarda Energy, they have a hydro power plant, so they have captive power consumption, and they also have a captive iron ore mine at Raj in Chhattisgarh itself. And however, the other two mines that they have are coal mines, but they are commercial mines. They're not captive mines. Sandur Manganese, if we see, they have a legacy business wherein they are involved in the mining of iron and manganese ores, respectively. And they are the fifth largest iron ore miner in Karnataka and the largest private miner of manganese ore in India. However, they also lease all the mines that they mine from. So here, if we see the most backward and forward integrated advantage, I think GPIL would be in the best position. So if we see their EBITDA, sorry for the merging. But EBITDA percentage and PAT percentage, EBITDA is the orange line and the PAT percentage is the blue line. So GPIL, I'd say, is doing comparatively better when you see compare it with Sham Metallics or Sarda Energy. Sandur Manganese is doing much better than all these companies. Lloyds Metal is doing slightly better than GPI, but I'll show you the scenario with Lloyds Metal. So if you see, Lloyds Metal has an ROA of 64% and an ROE of 91%. Now, I don't know exactly how their business works. I might need to look into it more to understand why their ROA and ROE numbers are so high. One reason could be our next graph, that is, they are basically debt free, but that cannot be entirely the reason. But let's compare GPIL with Sham Metallics and Sarda Energy and Sandur Manganese in this case, and just ignore Lloyd Metals for a while. So if we see ROE, ROA wise, GPIL is doing better than Sham Metallics, Sarda Energy, and Sandur Manganese here. Yeah. So so their DE ratio as well, if we see, GPL is doing better than Sham Metallics, Sarda Energy, and Sandur Manganese. As in, if you see their interest coverage ratio, GPL's interest coverage ratio is much, much higher, and they can cover their interest expenses easily, I'd say. Whereas Lloyd Metals, if we see, they have no debt. So it would be interesting to read about Lloyd's, what they do. And one more thing is that even the NFAT, which I realized I've not included the graph for. NFAT, if you see, GPIL, if you compare with Cham Metallics, Sarda Energy, and Sandur Manganese, GPIL has a higher NFAT at 2.3, whereas Sham Metallics is at 2.2, and Sarda Energy is, I think, at 1.4, and then Sandur Manganese is at 2.3. Whereas Lloyd's Metals has a NFAT ratio of 3.7. Lastly, we'll just see their price to book value. So GPIL is trading at 1.8x and Sham Metallics is trading at 1.3x, whereas Lloyd's is trading at almost 13x, and Sarda is trading at 1.6x. Sandur is at 1.7x. Yeah, so let's talk about the growth triggers. So the growth triggers, what I would want to say is they are not near term triggers. They are either medium term or long term triggers. So they're on track to achieve their guidance for iron ore pellets of 2.6 to 2.62 millions. That is for FY24. And then next year they'll target 2.7 million tons. And eventually they'll also be expanding capacities. So in the next 3 to 5 years, you can see a major improvement. India's iron ore and pellet exports is on the rise. Plus, there is higher domestic demand as well. In 2023, FY23, China accounted for 85% of Indian. And that's why I was talking about, when I was talking about buyers, I was saying China is the major importer, as in, yeah. So accounted for 85% of Indian iron ore exports in FY23. Out of that, nearly 11 million tons were shipped in January to March 2023. That would be quarter three of FY23, if I'm not wrong. Uh, then we have, the company, the management has declared that they will be increasing their mining capacity to more than 2x in 3 years and then 4x in 6 years. However, these are again long-term growth triggers. So this not very near term, but it could be. It's not very easy to predict, but there was an article that I read. So it basically said realizations of Indian iron ore pellet makers could rebound as analysts expect ferrous prices to bottom out soon after correcting over the past year. So basically, the international spot price stands at dollars 130 per ton. That is 26% lower than the 5-year average of dollar 164. So the domestic pellet prices that are measured by Steel Mint, they have a bi-weekly index. They have dropped 7.2% this year to rupees 9,000 per ton in the first week of July. And according to a report that was given out by Motilal Oswal, ferrous prices now have approached their bottom and they have fallen 10 to 15% since February, and they're expected to increase from here. So the rebound from here would basically aid realizations of pellet companies like GPIL and then even Sham Metallics. So in the medium term, you can expect growth on the basis of this. So the performance and valuations of both the companies correlates highly with the pellet prices, because as we saw FY23 46-47% of the sales were from iron ore pellet sales. And yeah, so if the prices of pellet increases, this will be a key advantage for them, but yeah, again, hard to predict. uh, then yeah, they have also recently launched a new grade of pellets comprising iron at a price of rupees 11,200 per ton. Then they are also holding back Fe 63% pellets, while other players are offering at a lower price, that is 8,900, 9,200 rupees. Like I said, the prices are bottomed out and they're expected to increase. So if they're holding the stock and they're planning to sell it further, if the prices are expected to increase, they'll benefit from this as well. And then one disadvantage we have spoken about throughout the presentation, that is their continued backward integration and forward integration. They're always making efforts to increase the capacity in for their captive consumption, and eventually their external dependence for power will be negligible after they will complete their current ongoing 85 million watt captive power projects. And yeah, improved debt metrics as well. They are continuously focused on improving their debt metrics. I mean, they're already a net debt-free company, and whatever CFO that they generate should help them reduce their short-term debt significantly. So this will also give them a better valuation, I think. So the growth that they can see is either from price-led growth or a demand-led growth. And currently, the demand is increasing domestically as well as internationally. And prices, like I said, there is a chance that the ferrous prices will increase from here on. So yeah, these would be the medium-term triggers for this company, I'd say. I'll go to the valuation. Okay, so for the valuation, I've taken, I'd say, a little bit of a weird approach. I'm not sure if it is correct, but I'm going to start presenting now. So for sales growth, let's start with sales. So these are very random figures, 15, 14, 15, 4 and minus 23%. So for this, what I've done is basically I've tried to project their revenue. So what a company does is they don't give any sort of guidance as such, but what one guidance they give is the amount that they intend, the amount that they will produce in the next financial year. So for FY24, they have given guidance of each of their products, that how much they will produce for the year. So what I've done is basically I've taken the FY23 production, how much they produced in FY23. This is all in million tons. And then I've taken how much they sold in FY23, these amounts. And then I've taken the sales percentage uh, of this as a percentage of the production. So 1.9 million of 2.6 million is around 75%. So what I've done is I've used these values again in the FY24 guidance. So what they have done is they have given FY24 guidance for each of these products. Sorry, like iron ore pellets, they intend to produce 2.6 million tons of iron ore pellets. So what I've done is I've taken 75% of this and taken an expected sales figure for FY24 that comes to again 1.96 million. And then I've done the same thing for the rest of the products. And then MS rounds, SBYs, what happens here is they have given a combined guidance for their rolled products. So I've averaged both of them and I've averaged out. They have given a guidance of 2.2 million tons for both of them combined. So I've kind of averaged it out and taken an expected sales again for this same. And ferroalloy is again same as the rest. I've taken an expected sales figure. Then what I've done is I've taken the rates of each of these products for the last 5 years. They list this out as well. That is the price they realize, their sale realization price. And what I've done is I've taken each of these products prices for the last 5 years, and then I've taken a bear bull case, as in the minimum price of the last 5 years I've taken as the bear case, and the maximum price is the bull case, and the base case I've taken FY23 prices because of that article that I read, that is the prices like iron ore pellets and ferrous prices are expected to increase from here because they are bottomed out. And that is I've chosen to take FY23 prices. Firstly, I was taking median, but I thought this was making more sense. Then I've tried to project the revenue for FY23, FY24. That is, suppose bear case, I'll be multiplying this by the expected sales, and that will give me the sales in rupees. Sorry, yeah, that gives me 1,339 crores. Suppose the same I've applied for all of these, and then base case say I've taken the 9,400 rupees. That is the same as the last year, and each of these I've used the same logic, and then I've added up the revenue from the steel segment. So this is only the steel segment, right? So then 4,000, let's say the base case, it comes to 4,618 crores. Then what I've done is, now this was slightly difficult for me because the revenue from power segment is rather confusing because they don't list anything about their power segment. So what I did was I determined a figure for power segment, as in added up their sales for FY23, the total sales from the steel segment. I've added up the amount, and then I've subtracted from the total revenue. Then then you kind of see 1,342 crores come from the power that they sell. So here, this might not make a lot of sense, but I've used the same figure for next year as well because I was not sure how to make an assumption here or take a bear, bull, and base case. So I've just used the same figure everywhere, and then I've added it with the revenue from the steel segment. Then I get my base case at around 3.6% growth, and then bull case at 15% growth, and worst case at minus 23% growth. That is at the worst prices. This is not most likely not possible and would happen, but the bull or bear case, bull or base case can play out. So for the valuation model, what I've done, so this is how I justify the three percentages, because one other thing I could have done is, I mean, if you see, sorry, just 1 second. Yeah, if you see the sales growth for the past, say from 2012 to 2023, 10 years, then you see how random the percentages are. So to take a number or a figure from here by taking an average or a median, it'll be very difficult for me to justify or back it up. So I thought maybe I could try this rather. And then what I've done is I've taken the material cost. So material cost, the same way, what I've done is I've taken the past 6 quarters raw material cost. I've averaged it and I've taken that value for the base case. And the best case from the last 6 quarters, I've taken it as the bull case. Worst case, I've taken as the bear case. And then we come to our gross profit of around 44%. And then a manufacturing cost, what I've done is for the past 5 years, I've taken the average as the base case. And the best case, that is 11%, when it was at the lowest, I've taken it as the bull case. And the worst case, that is 15%, I've taken as the bear case. Employee cost, again, the past 6 quarters, I've taken the average that comes to around 3%. Yeah, comes to around 3%. And the worst case I've taken as the bear case, and the best case here is 3%. It has never gone above more than 3%. Sorry, it has never gone less than 3%. So I've taken 3% as the best case as well. One more thing I forgot to mention is that gross profit margin as well. If you take the average of the last 6 quarters, it comes to around 44%. Even the last quarter they did 44%. So even I think that is also justified to get a 44% figure here. And then other cost, what I've done is I've again taken the average of the last 3 years, and then for the worst case, I've taken the highest in the last 5 years, and the best case, I've taken the lowest in the last 5 years. Bull case, sorry. And then we have our SG&A and then total expenses. And then we come to the EBITDA of around 1176. So the EBITDA margin is at around 20% for 2024. I mean, this too makes sense because the company itself, they are also guiding it to be around 18 to 20%. And I think in the previous quarters, if I'm not sure if I'm taken it down, yeah, in the previous quarter also it has jumped back to 20%, from the lower margins in FY 2023 that were because of the import duty by the government. And then the depreciation amount, I've used our usual depreciation model. I've taken 6% as the depreciation of the fixed asset, and the depreciation comes to around 128 crores. So I've used the same figure here. Other income, then we have finance cost. So finance cost, what I've done is I've used the interest model. So in the interest model, what I've done is the CFO by EBITDA, I have taken the average for the last 5 years, and the EBITDA is from the valuation model itself. Then the expected CFO I have projected by multiplying both. Then what I've done is, yeah, so what happens in FY23, their cash flow from operations was 962 crores, and their debt in FY22 stood at 428 crores. So what I've done is I've kind of, yeah, so I've subtracted these, that is 428 minus 316 comes to 111 crores. I've kind of seen how much debt they paid. That is, sorry, 112 crores almost. And then, yeah, so from the FY22 CFO, I've taken the percentage of the amount that they used to pay the debt. That comes to around 8%, 8.4%. And same way I've projected for FY24. That is, my projected CFO figure is 1088 crores. So 8% of that will be used to pay the debt. So 316 minus that amount. That amount should be around 87 crores. So yeah, so then it will come to 225 crores. And then the interest cost for last year was 6%. So I've taken 6% of 225, 226, 225 crores. That is 14.5, around 15 crores should be the interest cost. So that I've used here. Then the profit after tax comes to 775 crores for 2024. Then then we come to the valuation. So for valuation, I've taken the 5-3-1 year median here, but I've used the past 2 years median, that is 0.8 average. And then I found the market cap by multiplying. Okay, yeah. By multiplying it into sales, and then the current market price by dividing market cap by the number of equity shares. So that comes to around 548, but currently the current market price is is at 544. It's only a 0.75% increase. Again, EV EBITDA, I took the past 5 years EV EBITDA and I took the average of it, and then I took the expected enterprise value by multiplying this 3.6 by the sales. And the debt is from the interest model itself. We saw 225 crores, and I've used that. And the cash and cash equivalents, have kept it the same as 2023, that is 800 crores. Then I'm use the formula, that is 4234 minus 225 plus 800, that comes to 4809. And then this divided by 8.7 will give us 553. So that is a 1.61% increase. Yeah, that's about it. Thank you. No, it's very faint.
Am I audible?
Oh, I think is it my audio? Because 1 second.
I think you're perfectly audible. Can you hear me now?
Yeah, now I can hear you.
Yeah, cool. Yeah, good presentation, Shantanu. Overall, got the overall picture. So if I have to look at it from a triggers point of view,
Hmm.
uh, what you're saying is that their current mining and pellet capacity is around 2.3 million tons or 2.4 million tons, and they are going to increase that to 6 million tons over 3 to 5 years. Is that
Yeah.
understanding correct?
Yes, correct.
Okay, but FY24, not much is going to happen, is it? Because you said
No.
something like 2.7 million tons only or something like that.
Yeah, FY24, nothing much is going to happen. And rather, they've already given guidance for how much they're going to produce for
Okay.
FY24.
Okay. So your revenue projections, you are fairly sure that, I mean, I saw the approach. I think it's a very tough assignment to sort of try to project this. It's very difficult because
Hmm.
prices will fluctuate as per market, and
Yeah.
very difficult to actually, understand that. But I think your approach is fair. So you're saying that capacity in FY24 versus FY23 is not going up much. It's going up
No,
by only around 10%.
no.
Okay. So why is the market giving it such a steep valuation compared to its historical numbers? Is it because this 20% EBITDA assumption, the market thinks that margins are going to be much better? So what are the margin? So the gross margin you've assumed is 44%,
Hmm.
right? But if I look at earlier years, if I look at say 2021, yeah, 2021 they did some 53% margin, yeah. 2022 they did 56%, before that 45%, 44, 44. Okay,
Hmm.
yeah, so maybe FY21 and FY22 were a little extraordinary in terms of
Yeah.
margin. So yeah, fair assumption. Looks like your assumption is fair. So why is the market overall, your valuation approach, etc., is fine? I mean, you've used historical medians. I don't understand why the stock has gone up so much in the last few months. So is the market discounting something that we are missing? That margins will go to 25% or revenue growth will be higher? Any sense of that?
Yeah, I think they've already taken into consideration this, like the EBITDA percentage will be around 18-20% for FY24. And then margins, I'm not sure, but the triggers like the capex expansion and everything, they've already included that. I think so.
Okay, but that's what I'm saying. So including that also, whatever EBITDA you get, if you slap the median multiple on it,
Yeah,
it's still much lower than what the current market cap is, right?
yeah,
So
yeah.
if
That
you,
that it is.
yeah, if you use, I think just go down once a
Yeah.
little bit to the EV EBITDA valuation. So here, I think you forgot to add the net debt maybe to the
Hmm.
yeah. So anyway, so you're saying that around 4,700, 4,800 should be the market cap, but the current market cap is something like
11,000.
yeah, 7,600.
Yeah.
Yeah, so this gap is what I'm not sure. Maybe it's a re-rating because this
Hmm.
company was trading very cheap for a very, very long time. If you see
Yeah.
the kind of ROEs that the company has been delivering, its ROE last year was 22%. 3-year average is 35%, 5-year average is 32%, and 10-year average is 24%. So a
Hmm.
company with this kind of ROE and decent sales growth of 5-year sales growth is also pretty decent, 18%. So that probably deserved to trade at higher multiples. So maybe
Hmm.
this is a multiple re-rating. I don't know.
Could
I
be.
don't know what has triggered it. Because generally, multiple for a market to not value a company which has been performing well for a very long time and suddenly to re-rate it, you will need some kind of strong trigger, right? Maybe a
Yeah.
very famous investor takes a position or like something happens, some narrative change should happen. So anything like that you've come across?
I had, but I will get back to you soon because I
Okay.
had done this quite a while back, but I had noted it down. It was in Value Picker itself, I think.
Okay. Okay.
I
Okay.
went to the date since when the like kind of the upward movement started, and
Okay.
then I found something I remember.
Okay. All
Yeah.
right. Yeah. So
So
that's it.
if you look
Yeah.
at August October 25th, in 1 week it grew by 5 times.
Hmm.
It's a huge candle.
When in?
October 25th, 2021.
Oh, 2021. Okay.
Yeah. It
Mhm.
just shot up by 5 times in 1 week. So maybe a 20% circuit.
Mhm. Mhm.
But so Nirvan, I was looking at multiple companies in the metal sector, and I see
Yeah.
that there's a lot of re-rating that has happened. I
Yeah.
mean,
Yeah.
historically, before 2019, it was trading at say some valuation. I don't know, nine. Uh, I mean, price to sales would be below one, or it was low, and now in the next 3 years, it's been higher. Maybe I don't know, this decoupling from China, global decoupling, that sort of gave a nice re-rating of it, that globally big industrial nations will not allow China to kind of push their product, and there
That's
would be
not
some barrier.
actually, Gaurav, as
Hmm,
far as I know, as apart from some specialty steels, etc., that is actually not true. So
hmm.
even like you remember the session that what's his name, the steel expert who had come to
Yeah,
Goa.
yeah, yeah, Rakesh Arora.
Yeah, Rakesh Arora. He said the only way to track metals is to keep tracking China, even now, right?
Hmm,
So
hmm,
there are some themes of decarbonization, etc., which is sort of
hmm.
making a China plus one theme, but it's still like not significant enough, right?
No, no, I'm talking from a re-rating perspective. I mean, why would
Yeah,
re-rating happen? It would be
that's
happening
what.
because I perceive that. I mean, so
Yeah.
say for example, if I have to buy that, I would perceive that now the cyclicality probably, or the dumping nature of the steel might go away. So that way,
Hmm.
I mean,
Possible.
from a perception point of view, not like realistic what is happening, or the day-to-day price or demand and
Right.
supply.
But that's what. So, like this kind of valuation expansion in GPIL seems a little excessive to me. So, for
Hmm,
example, it is right now trading at 1.3x sales, when
hmm,
the median price to sales has always been less than one. So
hmm,
30% premium to median. So, what is pushing that is my question. See, one thing has happened, Gaurav, is steel was going through a very bad cycle for half a year, 1 year, and now it
hmm,
is slowly starting to bottom out. Yeah. So
hmm,
that is why Sham has also increased and all of these stocks have moved. But
hmm,
GPIL for some reason has gone into sort of euphoria territory. So is
hmm,
it actually market being sort of euphoric, or are we missing something? Maybe it's market being euphoric. And to be
yeah.
honest, if you look at their ROE numbers, they deserve a better multiple. And this current multiple is not that bad. So because you see the cross cycle ROEs, even in bad years, they have done good ROEs.
Hmm, hmm,
So
hmm,
maybe that's what. So if this is suppose a re-rating which is happening, and the re-rating is not happening over the last 2 3 years for GPL, it's happening right now, right? It's happened in the last 2 3 months, right?
hmm, hmm.
So it'll be nice to understand if this is something which is sort of, the market has changed its mind about the stock, and now maybe permanently will it trade at a higher level.
See,
That is my
I,
question.
I was talking with this guy. I mean, this transportation guy. I remember there was
Yeah,
Abhimanyu, right?
yeah, yeah.
So he from somewhere got to know about GPIL, and he had GPIL. So I mean, in some investor circles, maybe it was thought of as a good opportunity because, uh, yeah, I mean, from a perception point of view, again,
No, even on Value Picker, there's this guy called Kumar Manas who is the biggest supporter of GPIL, and he
GPIL.
keeps posting. GPIL is a very well-tracked stock, Gaurav. So
uh,
a lot of people have made money in GPIL because when it comes down to reasonable valuations, people buy and then they make good money and sell again, at the top end of the valuations. This time, the valuation has sort of reached very high. Maybe it will top off now. If you look at the market cap to sales chart, Gaurav, you
huh,
will see that it tops off around 1.5x sales max.
correct, correct.
So maybe that's what you were also writing in the chat, I think.
Hmm. Because
So
I
yeah,
will never pay more than 1.5. I mean, then there's no margin of safety, right? I mean,
yeah.
one quarter bad. Another thing, I mean, do you think the Indian government's anti-China policy sort of gives a sort of mental peace to people investing in such commoditized businesses?
I don't think, Gaurav, because
Hmm,
see, I would have said agreed with all this if the re-rating had been happening slowly for the last 2 3 years.
hmm,
What has it was down in the dumps right now. Valuations
hmm,
were very
hmm.
bad till about 3 4 months ago, and now suddenly it has gone up. And
Hmm.
I don't know
Okay.
what is the reason. See, if you see from 9th June, it has started moving. This
Yeah.
stock has started moving from, sorry, 26th May around. Yeah, it was at 360 rupees. and it has gone up to 541 now. So it's up by 50%, right?
Yeah.
That has not got anything to do with China, in my opinion,
Uh,
or government stance, right? Because in the last 1.5 months, what has happened?
Nothing much. Sector rotations. I
Yeah,
think
yeah. I
sector
think
rotations and money just flowing here and there. I mean,
correct.
the entire thing about inflation sort of coming down and all. So
Yeah,
people are putting money. That's
possibly.
my take on it.
Yeah, same. I tend to agree. So
Uh,
Shantanu, maybe get back to us on that if you can understand why this price move or like what is happening here. Yeah, I think we
yeah.
cannot buy this stock because this the move is
I am
already
now
happened. Yeah,
I am now thinking about selling BK because if you look, BK has also reached a peak valuation.
is it okay?
I mean, look at it. No,
Yeah,
BK still,
let me open it.
or should I?
Of price to sales. Yeah, it has gone up. It has cleared its all-time highs recently.
Hmm.
Has gone up. Yeah, that's
Since you
true.
talked about that stock, that stock already made 30%.
Yeah, yeah, it has gone up by 30%.
I think good
I
time to
think
exit.
I think in December is the new facility that comes online.
Huh.
So before that, nothing much fundamentally is going to happen. Let's see the quarterly results, and then we can take a call. I think
Yeah.
yeah,
But but
possible.
but but the stock is moving every day. I mean,
Yeah,
it
yeah,
goes up by 7%, falls down to 1%, again goes up and settles at
right,
2%, 3%. So
right,
pretty
right.
interesting how the metal sector is going.
Yeah, no, definitely. I mean, the bottom is, I think, about to happen in Q2 in terms of realization. So that way, I think stocks are well set up. But
Yeah.
yeah, okay.
Hey,
Any
do
other
you?
comments?
Yeah.
Go ahead, Gaurav.
No, no, no. Finish this and then I
No,
have
no,
a question.
I was asking you only. Any other comments on GPIL? Or
No, 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 none.
okay, okay, cool. Yeah, you were asking.
So my other topic was maybe I'll stop recording first